Okay, good evening, everyone, and thank you for joining us this evening for our financial awareness seminar. My name is Paige Hanna, and I am the Assistant Director of Marketing here at Accelerator, and I will be your moderator for this evening. So we are very delighted to have one of our very own Accelerator business advisors who will be speaking on the importance of maintaining your business financials. And to start us off and kick us off, I invite our Deputy Director, Nicholas Higgs, to bring welcome remarks.
Good evening, everyone. And I'd like to thank Davinia, Executive Director, for hosting this event as well. I'd like to thank our colleagues and small business owners for attending this financial awareness seminar. The Access Accelerator Small Business Development Center is an organization that exists with a simple goal: to help small, medium, and startup businesses to succeed. Through our work, we have found it to be one of the most difficult things that occur for small businesses owners is managing their finances. So what you find is that the financial records aren't kept as well as they should be, or that they're not maintained in a manner which can be utilized to make decisions for the future or to raise funding. That's why this event was created. We believe that through this seminar, you will walk away with an understanding of why staying up with your business financials is vital to your success and will lead to better practices that will positively impact your businesses. Thank you again for joining us. We look forward to hosting many more future webinars and events on topics, industries, and opportunities that will help you. Thank you.
Thank you, Nicholas. Okay, so we are going to jump straight into it. So just some house rules. What is going to happen is we will have a presentation by our speaker, and then we will have a question and answer period towards the end. If you do have any questions, you can go ahead and put them right in the comment section, and we'll have someone fielding the questions over to us, and we'll answer as much questions as we can given in the allotted time space at the end. So I'm going to go right into it and welcome our speaker for this evening is Mr. Darvin Russell. Darvin Russell is a former corporate executive for several Fortune 500 companies and currently serves as a small business owner, speaker, and business consultant. He has garnered an expertise in various industries, including commercial banking, pest control, farming, retail, and logistics. Currently, he serves as the owner and general manager of Orkin Pest Control Bahamas, as well as an Access Accelerator business advisor with the SBDC. He is the former general manager of DHL Express in the Bahamas and the head of process improvement for the Caribbean, while serving as a leadership facilitator for the Americas region. Prior to DHL, Mr. Russell served as a professor of finance and economics at the University of the Bahamas. Mr. Russell obtained his Master's of Business Administration from Ohio State University in finance with a minor in real estate and a bachelor's degree in economics from South Carolina State University. He is an avid reader, former talk show host, and debater, and can be found every Sunday faithfully attending Mount Tabor Church. Mr. Russell is a former lecturer at the University of Bahamas, where he specialized in finance and economic courses. He is a regular public speaker at forums and workshops on entrepreneurship and business strategy. During his spare time, Mr. Russell serves as a volunteer at his church and appears on various talk shows where he discusses personal and business finance. Welcome, Mr. Darvin Russell, and you can take it away.
Good evening, everybody. Thank you, Paige, for that introduction. Hopefully everybody can hear me. Apologize again for the late start. So I'll try to make up some of that time and allow enough time for your questions. And hopefully the presentation will bless you this evening and help you with some of the challenges you may be facing as small business owners. So tonight we're talking financials, and we're talking about those documents, those spreadsheets, those interesting items that a lot of people dread completing and using in their businesses, because a lot of times they're quite daunting to prepare and oftentimes to understand. So hopefully by the end of this evening, I will demystify for you some of the challenges that people face when preparing and understanding their financial statements. So as I say, let's begin at the beginning, shall we? So what indeed are these financials? Well, There are three of them that we're going to talk about tonight that I believe are most critical for you to get a handle on and understand. And the top two, the balance sheet and the income statement, are the most critical ones for you to understand. So what is the balance sheet? The balance sheet, the thing that you need to recognize about the balance sheet is the balance sheet is a financial statement that is about a point in time, meaning your balance sheet is effective at the end of December 31st, 2019, 2020, July 31st, 2021. So it's just a point of time. It is recording all of those balances in the accounts on that financial statement at that point in time. The income statement, however, is the one that we are most familiar with, and that's one that we call the profit and loss statement, is another name that it's referred to as. But the income statement is the official accounting term for that statement. And the third one is the statement of cash flow. Both the income statement and the statement of cash flow are statements covering a period of time. So you might hear financial professionals speak about this is your revenue for the first quarter of 2020. So it covers the first 90 days of your fiscal year. More importantly, or most frequently, you would see income statements that cover an entire year's worth of activity. So your P&L, your income statement, it covers from January to December, typically covering the company's entire fiscal year or calendar year of activity. And finally, the statement of cash flow. So that is just the accounting of cash going in and out of your business, the reconciliation, if you will, of the various cash items that affect your cash balance or your bank account. So let's take a look at the balance sheet a little in depth. As I said, the balance sheet is a statement reflecting a point in time. What is on this balance sheet, you may ask? Well, as you can see from the slide presented, the balance sheet is comprised of your assets, your liabilities, and what we call stockholders' equity. So the simple formula that some of you remember from college, from high school, or that you've learned along the way is assets equal liabilities plus equity. So that total number that you see reflected on the slide of 770,000 is a combination of the 481 in total liabilities plus the 289 in total equity. Okay, so the asset side of your balance sheet, I like to think about it this way. I say assets reflect what you possess. And the reason I say that it's what you possess and not what you own is because oftentimes we have debt associated with these assets. So the second piece of your balance sheet are your liabilities. And these are the items reflecting what you owe. And oftentimes they're what you owe against those assets. So for example, you may have a building that your business is housed in that you possess. You built it, you borrowed money from the bank to acquire it. So if the building, for example, is worth $100,000, that $100,000 sits on your asset side of your balance sheet. You borrowed $80,000 to fund that construction and the building of that building. That $80,000 sits on the liabilities side of your balance sheet. That is tied to that piece of real estate. Because you put $20,000 down to purchase that, that $20,000 sits in retained earnings on your balance sheet. So if the assets are what you possess, the liabilities are what you owe, then what's left, as in the example that I raised, that $20,000, that is actually what you own. So your net worth is a reflection of what you own, what the business is worth at a book value level. So let's think about this if you are an individual, if it make it easier for you to digest. So you own a home. Your home is worth $200,000. You have a mortgage for $180,000. That means you got $20,000 in equity in your home. If that is the only asset that you own, that $20,000 is your net worth. Make sense? Awesome. So let's take a look at the income statement. Unlike the balance sheet, which is a point in time, I said the income statement covered a period of time, a quarter, a month, a year. Typically are the points and periods of time that we review our income statements during those breaks, those tranches, if you will. So what does this income statement do? Hopefully you can see that illuminated on the slide. And the print is not too small. But the revenue side is a recording of all of your sales. In some cases, you will see the word turnover used, but I prefer to say sales or revenue. It's a more modern day term for you to use when talking about your revenue or your sales on your income statement. So this is all of the sources of income that your business generates. So you sell clothing. So all of the items of clothing that you sell would be recorded on your income statement. If you, for example, sell food, all of the receipts related to food and beverage shows up in the revenue. You may also have a delivery service as a part of your food sales. You would separate that delivery revenue, but it would still show up in the same sales category, just under a different subheading. Okay. The other thing that's in your income statement would be all of your expenses. If you're in manufacturing, if you're in retail, I want you to think about your expenses in two buckets. One is what we call variable expenses, which is what your cost of goods sold represent. And the other are considered your operating expenses. Those are your fixed bills, fixed items that occur every month, regardless of how much revenue your business generates. So let's talk about those variable items in cost of goods sold. What is contained in there? Well, glad you asked. Cost of goods sold would contain, as the name implies, the cost, the total cost of those goods landed on your shelf. So people ask this question all of the time. They're importing items for sale, for resale. They bought the item for $10, but by the time they add VAT, duty, trucking, et cetera, that item is $20 landed. What should be reflected in your income statement should be that total $20, not just the $10, which was the cost of the actual purchase. Okay? So that needs to be reflected, the total $20 needs to be reflected in your cost of goods sold. That's very important. On the other side, the operating expenses side, you can see from the graph represented what the items are that would be reflected there. So all of your fixed items, your salary as the owner, your personal, the salaries of your administrative staff, your sales team, et cetera, your light bill, your rent, your marketing expenses, all of those fixed expenses that your business is going to incur regardless of the volume of revenue associated with your company. And after you now take away all of your cumulative expenses, both the variable as reflected in cost of goods sold and the fixed items as reflected in your operating expenses, what's left is your profit. Now, hopefully for you, your profit is indeed positive. So while from an accounting perspective, you can have negative net income, we're hoping that that's not the case. However, as a business owner, if you're just starting out, I don't want you to be too alarmed if your number in your first year is negative. That's quite common, right? So the way that businesses mitigate that or adjust for that is usually they have a cushion, a cash cushion that they reserve. It's a part of their working capital that they reserve in order for them to weather the storm until they can be profitable. Statement of cash flows. Won't spend a whole lot of time here because it's not a statement that we, when I was a former banker, that we reviewed a lot, but it's just for your edification, for you to understand what's in it. It's really just the ins and outs. It's also a statement about covering a period of time, but it's the ins and outs in your cash account broken down into those categories, right? Operating activities, investing activities, and financing activities. Don't be too overwhelmed if this is one that you don't understand. The income statement and the balance sheet are the two statements that you're going to spend most of your time with as a business owner. Now, why are these important? Darvin, you went and you told us what they are, but why are they important? Well, I think financial statements are important for a multitude of reasons that we're going to get into. But I want you to think about your financial statements and your finances in two categories. I want you to think about how you analyze them, why they're important before you open. And then I want you to think about them, why they're important after the business opens. And we're going to talk about before the business opens first. So the reason why your financial statements are important before the business opens, well, first of all, they allow you to evaluate whether or not it even makes sense to open a business or buy an existing one. Now, I'm a fan of buying businesses more so than starting ones. While I've started most of the businesses that I've owned, buying a business is not a bad idea. It allows you, first of all, to have some starting base, right? So you don't have to start from scratch, trying to generate customers, trying to determine what your profit and loss particularly is, and you have some basis from which you can launch your new business's strategy or how you're wishing to change it. But how do you evaluate using these financial statements whether or not to start or buy a business? Well, if you're buying an existing business, here are some things that I would like for you to consider. First of all, I need you to review what we call in business some of the ratios. These ratios are important for you to understand. These financial ratios are important for you to understand because they give you an absolute comparison, if you will, on your performance, a relative performance comparison, and a comparison over time. And we're going to look at an example in a few seconds for me to show you what I mean. They also give you a relative picture of the size of the business, right? When you look at somebody's income statement, for example, and you see the revenue associated with that business, it'll tell you right off the bat whether or not it's a small business, a medium business, or a large business. That's going to be important because that serves as a proxy for whether or not you can afford the business. So if the business is already generating $1 million in revenue and you only have $100,000 in total to invest, that's maybe not the business for you to go and buy. It may make more sense for you to start that business. The other point is, relative to its size, is you would have to consider, do I have enough capital? Does that $100,000 provide me, for example, the capital that I need to acquire this company? Okay, let's take a look at these ratios, a couple of them. So if you go to the second half of the page, you'll see ratios called the current ratio, which is current assets over current liability, quick ratios, debt to asset ratio, net profit margin, return on equity. Let's take a look at the net profit margin. What is the net profit margin? Well, that is the net income in dollars divided by the revenue in dollars. In this particular example, the net profit margin in the year 2004 for this company was 0.32%. In 2005, it was 6.94%. And in 2006, it was 11.93%. Let's break this down even simpler. If this company generated $100 in revenue, that means that in 2004, it only was retaining 32 cents in profit. If it generated $100 in 2005, that means the business, the owner of that business, profited only $6.94. And in 2006, his profit was $11.93, assuming his revenue was $100. Now you say, Darvin, well, that doesn't seem like it's a lot of money. Well, it's not a lot of money until you review his performance relative to the industry. Now, in this particular example, that's not reflected, but just for the purposes of your edification, let's say that the industry average in this example was 5%. On a relative basis, in 2004, he was performing worse than the industry. However, by the end of his second year in 2005, he was performing on a relative basis better than the industry. And in 2006, he was doing twice as well as the average person in the industry. Am I making sense to you? Awesome. So if you didn't have financial statements, it would not be possible for you to make a simple review or analysis just like I did with you tonight. So you looked at it in absolute terms. In absolute terms, he made 0.32%, 6.94%, and 11.93% in net income. In relative terms, relative to the industry. And when you're looking at your financial statements, you're also looking for trends. The trending of this business's net income or net margin in this particular case has been accelerating. So he has gone from a performance of less than 1% in profitability to within 3 years to be almost 12%. So this business owner is doing a fantastic job of managing his finances and generating the kind of profitability that one would desire if you're owning a business. You can see the very top line, another ratio or another metric that you would be reviewing your financial statements is his sales growth. So you can see his performance in 05 and 06, his revenue grew, his sales by 28.72% and 23.46% respectively. All right, let's move on. So the first example we said was if you bought a business. So for many of you listening on the call, that may not be the case. So you're starting a business. So if you're starting a business, you first need to begin, once again, at the beginning. How do you get financial statements in the first place? Well, for most of us, we have to buy some software, okay? So the first thing that you need to do is choose the right software based on, firstly, the nature of your business. If you're in retail, if you are selling baked goods, if you are in the farming business, if you're in a service business, all of these different businesses, it's important for you to consider what business you're in because certain financial software does a better job than others in creating or allowing you to prepare the financial statements that you're going to need at the end of the month. I just gave a couple of examples. Wave is one that a lot of you may be familiar with. It's an online, exclusively online application. Square is one that's quite familiar for those of you that receive credit card payments. Square does POS software, and we all know QuickBooks, which is probably the most common one that integrates both the front end, which is the POS side, the point of sale, so how you receive your money in your business, and the back end, generating complete financial statements for you. So it's a much more comprehensive solution, but it's by no means the cheapest of the options available. Now, if you have a degree of financial acumen, you can do a hybrid system where you can have Square because most of its features are free. And then on the Square would take into account or cover both the revenue side primarily, but on the expense side, you would need to do that somewhat manually and kind of merge the two to create a full set of financials. Okay, so that's for the more savvy of you who are very well familiar with how to do accounting and record keeping. If you're not there, I would recommend using Wave or QuickBooks for you starting out. Second point I'd make, if you're starting a new business, you got to think about what are those startup expenses. And I have the next slide. We're going to take a look at what is contained in those startup expenses, and think about how you estimate them. Oftentimes, when you're preparing your business plan for the first time, you have to come up with what we'll talk about last, which is your budget. But you also have, as a part of that budget, you have to come up with your startup expenses. And part of the way that you can estimate those startup expenses is you have a few options, right? Startup expenses cover things like your initial inventory, your initial rent, the equipment that you may need to start your business, for example. All of those things that you spend money on in order to get your business going. If you need a vehicle, if you're in the delivery business, that shows up in your startup expenses. So you say, well, Dee, where do we get these numbers from? Well, firstly, you can get quotes from vendors, right? Oftentimes, that's how most business owners, small business owners starts out. They get quotes from vendors. You can use your own personal experience. If you've been in the business before and you're restarting, you have a good sense for what things cost. You may need a refresher on some of the things that may have changed over time due to inflation, but you have a good sense for what the numbers should be. Industry statistics are great sources of information when you're looking for what an average business generates, for example, and what's the average cost of equipment for starting out a restaurant, et cetera, et cetera. Surveys is a great example. So if you want to ask people certain questions, if you're trying to generate an estimate, for example, on what people are willing to pay for a particular item, a survey is a great way for you to get at that number. Okay? All right. So from a budgetary perspective, we'll talk about that a little later. So let's look a little bit at this startup cost table that I printed out for you or posted for you. So if you look, this is broken down into two parts. So it starts by your sources of cash. So where you're getting your money from to start your business. And it breaks it into three categories. You, the investor, the cash that you're putting in. The second group is the loan, so the amount that your bank is putting in. And then if you have grant money or you have a situation where you have another source of funding, an alternative source of funding, you'd put that there as well. So you'd come up with a total funding source. And then all of those items reflected in startup expenses would be shown in the table below. And as we talked about advertising, we talked about nowadays social media advertising would be showing up in here. And then you'd see this category that talks about average monthly costs. And these are the items that you would basically spend money on or need to account for initially that form a part of your everyday operating expenses. So salaries, phone bill, gasoline for vehicles if you're in the delivery business. As we said, because you're starting a business, initially, you're going to need to have an estimate as to what your monthly expenses would be, because you're going to need to cover these costs with the initial capital that you, the investors, and the bank is putting into the business. You're going to need to do that at least for a few months until the business is profitable at a particular level, so that you can continue operating before you go out of business because you've lost so much money. Okay? All right. So what do we need to consider after we open? So the most important thing for us is the preparation of our budget for after we open. Well, we prepared the budget before we open, but the budget is really used after we open in terms of tracking our performance relative to the budget that we prepared. So the budget is important because the budget does, it measures, it tracks. Well, it really is, it's a tool by which we measure. Let me put it that way. So the budget is those estimates. It contains all of the assumptions that you've made about your expected business performance on a revenue side and on the expense side. It's critical for you to do that because in business, what we want is to track and measure the actual performance after we open versus the budget or what we said we would do before we open. So you said you generate $100 in the first month. but you only generated $80 in the first month. So you have what we call in business a negative $20 variance, okay? That's critically important because it means that you've fallen behind as a business person in your estimate as to where you expect it to be at this particular point in time. One specific ratio, we talked about a lot of ratios if you're an existing business. One specific ratio, if you're a startup and you've now opened, that I want you to pay attention to is this thing called break-even analysis. So this is critical because this is the number in revenue that you need to fight to get to as quickly as possible so as to earn a zero profit. So in the column to the left is your actual performance, and the column to the right is your budget. In this particular example, this company said they were going to do $57,000 in the first month of operation. They ended up doing a whopping $92,000 a month. So they have a positive variance, means that they generated $34,000 more in sales than they expected, and that was 60% more in revenue than they expected. Their cost of goods sold, you expect it to be higher. These are the variable cost items that we spoke about. But on a profit basis, on a gross profit basis, they expected on a budgetary perspective to generate $23,000. They generated a whopping $39,000 in profitability. You can see the other associated expenses associated with this company. So payroll was $3,000, meals, et cetera, et cetera. When you look at that relative to where their budget was, their variance was negative, means that they spent more money than they thought. Well, D, is that not a bad thing? Well, in absolute terms, yes, but in relative terms, it's not, because they obviously spent more money because they were generating a whole lot more profitability as a result of the additional sales that they generated. So this is a problem that you want to have as a business person every single day. And that resulted in a net operating income of $22,478 instead of what they budgeted, which was $7,283. Okay, so I know you're asking, well, how does that break even? What would that break even be for the company? Well, I did the simple calculation for you on the slide. So break even in dollar terms, you can also do break even in units, but I prefer the dollar calculation. It's your fixed costs, that $15,717. That's all of your operating expenses that we talked about earlier, divided by your gross profit margin. So the 40% in decimal terms. So 15,717.40. That means that this company needed to generate $39,292.50 in order for it to have a profit of $0. And that's the goal. When you're starting out, the goal is to get to break even as quickly as humanly possible. Okay? And finally, I'll wrap up with this. Why are financial statements so important? Besides the fact that we need them to track, measure, and improve our business performance, another key reason why the financials are so critically important is they allow banks and investors to evaluate our business, and they allow you as well, as we mentioned, to evaluate your business. Oftentimes, the banks use this as an absolute requirement or a contingency upon lending you money. Without proper financial statements for your companies, it is impossible for you to evaluate whether or not your company is doing well or poorly. And as we talked about, relative to your budget, relative to your industry's performance, relative to your own expectations, and relative to what your investors were expecting for the money that they either loaned you or gave you in the form of equity. So thank you for your attention. Hopefully this was helpful for you tonight. And I like to be disciplined when I speak. So hopefully I did it within the 30 minutes allotted. So I would be happy to take your questions at this time.
Okay. Thank you for that, Darvin. Again, if you do have any questions, you can drop them in the comments, but we do have a question here. The question is, how do I decide what my salary should be and ensure that my business succeeds, but that I'm not financially struggling? I am not financially struggling personally. So I'll ask the question again. How do I decide what my salary should be and ensure that my business succeeds, but I am not struggling financially, personally?
Okay, great question. So I'll answer it this way. If your business is your sole source of income, it would be irrational for me to tell you, don't take any money out of the business. Okay? So if it's your sole source of income, this is my answer. You should pay yourself only what you would pay somebody else to do what you do. So for example, if you own a small business and for somebody to manage your business, that's $300 a week. That's $400 a week. You shouldn't pay yourself more than $400 a week. Although you may be worth more than $400 a week, you shouldn't pay yourself more than $400 a week because the business more than likely can't afford it. After you've achieved a certain level of profitability, of course, you can take out in the form of a dividend or a special distribution as much money as you want out of your business over and above what you would want to reinvest in your business. If, however, you have an alternate source of income and your business is starting out as a side hustle, I would recommend that you don't take anything out of your business until your business achieves at least break even or some degree of profitability.
Okay, and while on the topic of, I guess, salary, how would you determine how much to pay your staff?
Okay. If you're paying your staff, you know, in Bahamian businesses, we would rather hire 2 people at $200 than 1 person at $350. Okay? What ends up happening is, for whatever reason, we like to see bodies in businesses because that makes it feel as though, I guess there's enough staff to support the client. I say you pay for performance. So because most businesses require some measure of productivity, you need to tie at least a portion of their salary to some productivity metric. Meaning, if you have a salesperson, their entire salary shouldn't be commissions. You can do it that way, but you probably won't get a lot of takers. So you can have a base salary, and then you can have a generous commission structure, meaning once they achieve over and above a target that you set, then they get X percentage of your business. What that base target should be relatively easy for you to determine. You can ask around what other salespeople make, other business owners. You can ask an accountant what people in a particular industry. You Google that question and find out what people in your industry make. The average salary in the Bahamas for entry-level people is somewhere in the neighborhood of $250 to $350, depending upon your industry per week.
Okay, thank you. Another question we have here. So I know you touched a little bit on, managing your financials.
Mhm.
Do you recommend any tools that one could use to handle like the technical portions of creating these financial like statements or like the financials and the business plans?
Yeah.
Are there any tools that
Yeah,
you recommend?
QuickBooks is the best for that.
QuickBooks does that as
Yeah,
well.
QuickBooks they can generate charts, graphs, all the bells and whistles that you would
And that's the
want.
financial statements and
It
income
does.
statements and
It
everything?
does. It does.
Okay.
Balance sheet and income statement. Yes, it does.
Okay,
It
okay,
is the most thorough software out there.
okay. So another question we have is how to decide when it's time to get external accounting versus whether I could do it myself.
That's a great question. All right. That's more a factor of whether the bank requires it. You may not have a choice. If the bank requires accounting prepared statements, and these are called reviews or audited statements, you have no choice but to do it. So I'm assuming you're asking that because you have an option. So if you have an option, I would only pay for accounting or CPA to prepare the statements to get an audit if your business can afford it. Audits can run $20,000+ a year and are absolutely not necessary for you unless you are a medium size, meaning you're generating over $1 million in revenue, or a large business. If you're a small business, an accountant can just review what you've done or send them in QuickBooks and basically validate that number for you to tell you that you're doing a decent job. That's a much more affordable thing. But I would say you would need, I wouldn't go through that effort or energy unless your business is at least generating about $250,000 in revenue. QuickBooks is more than fine.
Okay, so another question that I got here is, how much, I guess, percentage of your expenses should be to rent? If you have, like, say, a brick and mortar establishment, you know, maybe there's a recommended amount that maybe you shouldn't have your rent being over this much. Is there a recommended amount for something like that?
So for salaries, for example, the rule of thumb is like you don't want your labor to be more than 10% of your revenue, right? Now, of course, that's going to be higher when you start out, but you want that number to dovetail around that 10%. For rent, you can just think about it this way. If your building costs you $2,000 and it's 10% of your revenue, that means you need to be generating $20,000 a month in rent. I don't know if that's reasonable for you. Because rent is a fixed cost item, you should try to get your rent as cheaply as possible to perform the tasks that you need to perform. So it's not so much about a percentage of revenue as it is about a dollar figure that you're comfortable with or you feel as though you can easily afford, okay? The percentages are going to shake out, okay? But you shouldn't be, you know, your rent shouldn't be 50% of your revenue or something crazy like that. But by the same token, if your rent is $2,000 and you're only making $4,000 a month, you probably need to be working from home.
Okay, we have another question here. How valuable is data analytics to small businesses starting up?
Data analytics in terms of social media analytics, where is that? Can they clarify?
This came, let me see. The person who asked that question, could you just follow up to it so you can specify what it is that you meant, please? And we'll come back to it. But we have another question here waiting. As a small business owner, should we invest in QuickBooks software right away, or can we simply use an Excel spreadsheet?
If you can afford to, do it from the beginning. It's much more difficult to try to correct our mistakes in business after the fact. QuickBooks is, these things are very modest in terms of expense. But like I said, Wave is a free option. And it's all online, web-based. So there are options that you can kind of flex if your budget is that tight. But QuickBooks is a modest amount of money to spend. And quite frankly, you can do they still allow you to purchase the disk and load to your computer. So you don't have that monthly charge that you do with the online version. I think those are still available on Amazon. So you can just have that one charge and do your financials every month. But I would say just from starting out, if you can afford it, go with QuickBooks.
Okay. Another question from Facebook. In an effort to budget your startup as close as possible to actual values, when calculating your startup costs for your business in regards to purchasing assets, do you budget the average retail price of your product being purchased, or do you recommend budgeting for the most expensive product of that time?
Okay, that's a great question. So you always, when you're preparing your budget, prepare it based on the worst case scenario. So yeah, you would go on the high end of that average. So choose the more expensive option. So the highest price that you've seen over some period of time.
Okay. Another question. I recently opened a small store and recently retired. I don't have a cash register or all of the things you spoke about. Should I bank some of the funds I make to add up for the store? I can't afford to hire anyone. I'm not renting, but my son is assisting me. So I think the question there is, should they bank some of the funds? I'm guessing personal funds to put towards it.
Read it again for me, Paige.
I recently opened a small store and recently retired.
Mhm.
I don't have a cash register or all of the things that you spoke about. So I'm guessing that's like QuickBooks and these other tracking mechanisms.
Okay.
Should I bank some of the funds I make to add up for the store? The funds,
Okay, so
oh, so
hopefully,
should she put them in the bank or?
oh, so she's really old school. So she's saying whatever business she's in, she's generating some degree of profitability. Or can she assess that yet if she's profitable? So at a minimum, if she doesn't even have a bank account for the business, which it sounds like, if I'm understanding the question correctly, it would be difficult for her to assess if she's profitable. So she has expended a certain amount of her personal savings or her retirement lump sum that she received, and now she's generating some degree of income from this business. So she needs, even at a manual level, to at least track her sales relative to what the items cost her so that she can find out whether or not she's even profitable at a gross level. So, for example, if she's selling clothing, she's got a little convenience store, her sales were $1,000 in the month, and her inventory cost was $600, she needs to track that. Although that was from her initial startup inventory that she purchased, she needs to know how much of her inventory she sold out so that she knows if the profit is real, okay? Otherwise, she would be depleting her cash reserves without knowing how far away from break even she even is. So I would encourage her, she needs some type of tracking mechanism, whether it's manual on a spreadsheet or she's going to invest in some type of software. The cash register is not that big of a deal because it's a very static instrument. If she means a literal cash register, it's not doing anything other than providing a receipt for a customer.
Okay, so a follow-up, I guess, comment or question to the question about how important data analytics are.
Mhm.
Basically, what they were referring to is taking all the information and data about the company, whether it's sales or customer sales and transactions, and looking at the trends to say which area they're falling behind in, which
Yeah.
category or product is least profitable, if they need to cut it off, or
Yeah.
they just wanted to know if that is, how important is that?
If you're that
And is it
sophisticated of a
necessary?
small
Yeah.
business owner, I would say absolutely. That level of detail and analysis is awesome if you understand it and can get to it. So for example, you could have introduced a product for a particular category of clients. And while you're selling some of it, you're not selling a whole lot of it. But it's taken up a disproportionate amount of your either working capital or your inventory purchases. If your data analytics is broken down by SKU number, by item, by category of item, that would jump out at you when you're doing your review, and you would see that, hey, look, cashmere sweaters, yeah, I'm making 60% margin on them, but I got 20 of them left in inventory and I'm selling one a month. Versus a wool sweater that I'm selling 20 a week for 80 a month, but I'm making only 20% margin. That kind of detail would be very important for you to probably move out of that high-end category, because that market, although you wanted it, is not being generated, or to change your marketing strategy to pinpoint those potential customers in that area. So yeah, if you can understand it and you can get a hold of that kind of data, yeah, it's awesome.
Okay, and on the topic of data, I have a question.
Yeah.
So a few years ago, I had my own business. At the time, it was something that was new, it's something that didn't exist in the Bahamas as yet as a standalone product. It was an inflatable water park in Nassau. And from that, coming up with my pricing was a bit difficult because again, there was no data to
Nobody
go
had
off
it.
of.
Yeah.
And so when I went to my first pitch competition, I was like, oh, we're gonna make this much money. And I got ripped to shreds, right? They were like, you are out of your mind. Like
Right.
you're talking nonsense. So in those instances where we do have persons that come up with these innovative ideas that don't exist yet, what is your, I guess, advice for how to build your business model around that?
Sure. Great question. two things. If it doesn't exist at all in the world and you're new, then that's a little more difficult. But chances are the business exists somewhere else. So as a first step, you find out what they're charging in another market, in Florida, North Carolina, Georgia, wherever, okay? That'll give you at least some starting point, okay? Now you can say, well, if I go slightly above to adjust for cost of living in the Bahamas, the cost of business in the Bahamas, then, you know, that's one way to do it. Another way to do it is think about it in terms of the value that it gives to the customer. So regardless of the fact that it's a water slide or a golf or putt-putt golf or whatever the case may be, what people are buying is a certain amount of time at your facility, right? So that's worth $20 an hour. So if you say, because your alternative is, I can go to the game room and spend $20 an hour, or I'm coming to your water park to spend $20 an hour. If at $20 an hour times 8 hours a day times X number of participants, that number looks decent to you, and from your survey, because that would be this would be a great example of where you would want to use a survey. You would put on that survey, how much are you willing to pay for an hour at my water park? Put the $20 there because that's your most likely scenario. Put a higher number that you may really want to get, $30, and then you put 10. Okay, and that's how I would start to build a model like that for something that's not that common in the marketplace. That would probably inform your logic a little better than just picking a number that you really want to make out there that may not have any basis in market reality, because we could charge whatever we want to charge, but the market can't bear above a certain thing.
Right. And you mentioned looking, you know, at different countries. So in your opinion, should you compare prices? Let's say if it's something a little bit more average, not something as like different as a water park. Would you compare to the States or regionally? Like
I
within
prefer to
your-
compare to the States because not only is it familiar, it's more comparable to us in terms of cost of living, not in the sense that they're more expensive than we are, but most of their services over there on average are relatively more expensive. Goods are cheaper. So for example, if you're opening a salon in Florida, you're probably charging more in Florida than you are here in the Bahamas. But by and large, that's a much better proxy for estimation than it is using Barbados or Jamaica or Trinidad as a proxy for the cost of goods or for what your sales price should be for your business.
Okay, another question we have, are you familiar with Microsoft Dynamics 365? And is that similar to QuickBooks?
No, I'm not familiar with Microsoft 365.
Okay. I will wait 2 more seconds to see if we have any.
So let me answer the question that came up in our discussion, because it still hasn't been asked yet, about commingling personal expenses with your business.
Oh, okay.
So that's a question that gets asked quite often. So for those of you that your business is your sole source of income, I know it's very easy to happen where your personal expenses get ran through the business. I also am guilty of that at times, but I want you to resist the urge to do that. I happen to have a CPA that I live with called my wife, who can clean up my books for me at the end of the year. But I would encourage you to keep your personal expenses out of your business. And the way to do that is really just pay yourself a salary and use your salary for your personal expenses. That just keeps things really clean. So when you go to your banker and he's evaluating your business's performance, he or she and your investors can do it with a clean set of books without commingling your Amazon purchases on your corporate card.
Yes, I do remember we were speaking about that. So thank you for remembering to bringing that up. This is going to be our last question. We'll close out with this. As a business owner, I'm having trouble purchasing equipment from overseas using my personal bank account. What would be the best way for me to conduct business internationally when it comes to purchasing materials?
That's surprising. Because I regularly am able to do that without problems. So I would say you might probably need to talk to your bank or switch banks if that continues to be a problem. Second, you can get a corporate card at banks in the Bahamas. And thirdly, you can go still old school. I don't like doing it in the 21st century. You can just wire them the funds to make those purchases. It's quite expensive to do that. That's why using a credit card is a much more efficient way to perform that transaction. You can also see about trying to get a US-based card if that makes it easier. You can open a personal bank account in the United States with your Bahamian identification. Walk into any Wells Fargo or Bank of America, and you can open a personal bank account. So,
okay, I do have one more question. Then this will be
Mhm.
because I think this is important. You know, many small businesses, sometimes, you know, the owner is the only employee.
It
If my
is
product and service or skill and I'm the only employee, how important is a business account? Is that still mandatory? How does that work?
a business account, like
Yeah,
opening a bank
a
account in
business
your
bank
business
account.
name.
Yeah.
Absolutely essential. It's essential. Buying your software for tracking your business, creating your financial statements, and opening your bank account are absolutely critical things that you need to do as a business person. Bar none.
Okay, well, that wraps up our financial awareness seminar. Darvin, we are so appreciative for you taking the
Not a
time
problem.
out, in addition to being a great business advisor for the Access Accelerator. So we really do appreciate the insight that you've provided. Everyone, we will be editing this a little bit and we'll be posting it to our YouTube page on our website under our video library under resources tab, where you can find all of our previous seminars, webinars, which brings me to my next point is that we will be hosting more of these informative webinars where we'll be touching on different topics, different industries as we continue to provide small business owners and Bahamians in general insight on, you know, things that would be helpful for businesses. So we thank you again for joining us, Darvin. Thank you for your great presentation.
Thank
We
you.
look forward to other opportunities to collaborate.
Not a problem.
Thank you once again for your expertise. And thank you everyone for your questions and your attention. We will see you guys soon.
Bye-bye.
Okay.